What if I told you that one of the most powerful, yet overlooked indicators in the stock market is already on your charting software, and you're not using it to its full potential? Today, that changes. In this video, I'm going to reveal volume indicators, your new secret trading weapon. We'll dive into how you can use these tools to spot market shifts, confirm trends, and identify reversals. By the end of this video, you'll have a new perspective on analyzing charts and why volume is critical. Let's get into it. Let's start with one of the most powerful volume signals, volume spikes. These are crucial indicators that can help you anticipate major market moves before they happen. A volume spike is a sudden, dramatic increase in the number of shares being traded, often catching the eye of savvy traders. This spike is way above its average trading volume, making it a standout event on any stock chart. Think of it like a brand new iPhone drop, causing a surge in activity at the Apple Store. Everyone wants in, and the excitement is palpable. This surge in trading activity signifies strong conviction from either buyers or sellers, indicating that something significant is happening. If the price moves up on a huge volume spike, it suggests aggressive buying, as investors are eager to get in on the action. Conversely, if the price drops on a massive volume spike, it indicates heavy selling, with investors rushing to exit their positions. One of the best times to watch for volume spikes is around major news events like earnings reports. These events can drastically change market sentiment. Good earnings and a volume spike? That's a bullish sign, indicating that the market is reacting positively to the news. Bad earnings and a volume spike? That's a red flag, suggesting that investors are not happy with the results. Volume spikes can also occur around FDA approvals, new product announcements, or major economic data releases. These events can create significant market movements. A price move on low volume? That's questionable. It might not be sustainable. A price move on a massive volume spike? That's confirmation. It shows that the market is backing the move. Always compare the spike to the stock's average volume to understand its significance. A stock trading 2 million shares instead of 100,000 is significant. It shows a major shift in interest. Volume spikes are most powerful after a period of consolidation or low volatility. They can signal the start of a new trend. Pay attention to where the price closes on the day of the volume spike. The closing price can give you clues about the market sentiment. A stock that gaps up on huge volume but sells off to close near its lows might indicate selling pressure. This could be a warning sign. Conversely, a stock that gaps down on high volume but rallies to close near its highs could indicate a bottom. This might be a buying opportunity. Volume spikes signal heightened interest and strong conviction. They are the market's way of telling you that something important is happening. When you see price making a decisive move backed by a giant volume bar, pay attention. This is a clear signal that the market is making a strong statement. It's the market giving you a loud and clear message. Don't ignore it. Learn to listen to it, because it can be the difference between catching a big winner early or getting caught on the wrong side of a major shift. Understanding volume spikes can give you a significant edge in the market. We've talked about volume spikes, but what about volume trends? Volume trends can provide a deeper insight into the market's behavior over time. A volume trend is like the tide. Is it coming in or going out? Just as the tide's movement can indicate changes in the ocean, volume trends can signal shifts in market sentiment. A healthy price trend should be accompanied by a supportive volume trend. This means that the volume should align with the direction of the price movement. In an uptrend, we want to see volume increasing on the up moves and decreasing on the down moves. This pattern suggests that buyers are more active and confident when the price is rising. This pattern suggests more buying enthusiasm when the price is advancing. It indicates that the uptrend is likely to be sustainable. Conversely, in a downtrend, we want to see volume increasing on the down moves and decreasing on the up moves. This indicates that sellers are more active and confident when the price is falling. This indicates more selling pressure when the price is declining. It suggests that the downtrend has strong momentum and is likely to continue. Volume trends help you differentiate between a genuine trend and a potential fakeout. A genuine trend will have volume supporting the price movement, while a fakeout might show a price move without corresponding volume. A price rise on thinning volume is often a sign of weakness. It suggests that the upward movement may not be sustainable and could reverse. A price breakout with increasing volume is a positive sign. It indicates strong market interest and the potential for the trend to continue. If a stock is falling but the volume on the down moves is drying up, it might indicate that the selling pressure is getting exhausted. This could be a sign that the downtrend is losing steam. Always check the volume when analyzing a price trend. Volume provides crucial context. It helps you understand the strength behind the price movements. Is the volume confirming what the price is doing, or is it telling a different story? Conflicting signals between price and volume can be a red flag. Use moving averages on your volume bars to identify the trend in volume. This can help smooth out the data and make the trend more apparent. Volume trends are your friend when it comes to confirming the health and sustainability of price trends. They provide an additional layer of analysis that can enhance your trading strategy. By paying attention to these nuances, you can make more informed decisions and avoid getting trapped in moves that lack genuine market support. Understanding volume trends can be a game changer in your trading journey. We've covered spikes and trends in volume, but what about when things get too extreme? Enter volume oscillators. Volume oscillators measure the momentum of volume itself, rather than just raw volume levels. They help spot potential exhaustion points in the market. When the oscillator reaches an extreme high, it suggests buying enthusiasm is becoming excessive. Conversely, an extreme low indicates selling pressure is exhausted. Overbought doesn't mean sell immediately, and oversold doesn't mean buy immediately. These are warnings that the current move is getting stretched. Look for divergences between the oscillator and the price. A bearish divergence occurs when the price makes a new high, but the oscillator makes a lower high. A bullish divergence occurs when the price makes a new low, but the oscillator makes a higher low. Different oscillators have different calculation methods and sensitivities. Volume oscillators provide another layer of information that price alone doesn't give you. They help you gauge if the market is running smoothly, redlining, or about to stall. When used with price action, support and resistance levels, and other indicators, volume oscillators can be valuable for spotting potential reversals and managing risk. Let's talk about on-balance volume, or OBV. This powerful technical analysis tool can help you understand the underlying strength of a stock's price movement. OBV is a running total of volume, where volume is added on up days and subtracted on down days. Essentially, it combines price and volume in a cumulative way to show how money might be flowing in or out of a stock. The direction of the OBV line matters, not the actual numerical value. A rising OBV line indicates buying pressure, while a falling OBV line indicates selling pressure. OBV suggests that volume precedes price. This means that significant changes in volume can often signal upcoming price movements, giving traders a potential edge. If institutions are accumulating a stock, the OBV line will trend upwards. This accumulation phase can be a strong indicator of future price increases. Conversely, if institutions are distributing a stock, the OBV line will trend downwards. This distribution phase often precedes price declines. Look for confirmations or divergences with price. Confirmations occur when both price and OBV move in the same direction, reinforcing the trend. A rising OBV with a rising price confirms the uptrend. This alignment suggests that the trend is strong and likely to continue. A bearish divergence occurs when the price makes a new high, but the OBV makes a lower high. This can be a warning sign that the upward price movement is losing momentum. A bullish divergence occurs when the price makes a new low, but the OBV makes a higher low. This can indicate that the downward price movement is weakening. OBV is useful for confirming breakouts or breakdowns from consolidation patterns. When a stock breaks out, a corresponding move in OBV can validate the breakout. If a stock breaks out above resistance, you want to see the OBV also breaking out to a new high. This confirms that the breakout is supported by strong volume. If the price breaks out, but the OBV is lagging, it's a red flag. This discrepancy suggests that the breakout may not be sustainable. OBV is particularly useful for actively traded stocks, ETFs, and futures contracts. These instruments often have significant volume, making OBV a valuable tool for analysis. It helps you listen to the whispers of the market, the subtle shifts in volume that can precede major price movements. By paying attention to OBV, you can gain insights that might not be visible through price action alone. Let's dive into the volume-weighted average price, or VWAP. VWAP shows the average price a stock has traded at throughout the day, weighted by volume. VWAP is a benchmark for trade execution for institutional traders. When a stock is trading above its VWAP, it's in a bullish intraday trend. When a stock is trading below its VWAP, it's in a bearish intraday trend. VWAP resets at the beginning of each trading day. It provides a real-time, evolving benchmark of fair value for that specific trading session. The relationship between price and VWAP can tell you a lot about market sentiment. VWAP can help identify potential entry and exit points with more precision. Advanced traders use multiple VWAP bands to identify overextended conditions intraday. VWAP is most meaningful on stocks with decent trading volume. For actively traded stocks, ETFs, and futures contracts, VWAP is a widely respected tool. It gives you a crucial intraday benchmark, helping you time your entries and exits. Alright, so